Have you ever wondered how a simple idea, maybe one scribbled on a napkin, turns into a giant corporation on the stock market? Well, it's a wild journey, let me tell you. It's fueled by money, huge risks, and even bigger decisions. Today, we're going to climb that financial ladder, the one that takes a tiny startup and turns it into a public company, one rung at a time.
So, let's imagine this. You've got a fantastic concept for a coffee shop. You've got the name, you know the vibe, you've sourced the perfect beans. It's perfect, but there's one little problem. You're broke. You need cash to actually make it happen. So, where do you turn? Your first thought is probably the bank, right? But you're about to hit your first major wall.
Oh yeah, that wall is a fundamental truth of the business world. A great idea is basically worthless if you don't have the capital to bring it to life. So why is it that the most obvious place to get money, a bank, is so often a dead end for a brand new company?
See, a bank wants security. They're all about minimizing risk. They want to see assets they can take if you fail a proven history of profits. Your brilliant coffee shop idea? Well, it has none of that. To a bank, you're not this promising entrepreneur, you're just a giant question mark, a huge risk. So if you can't borrow the money, what in the world are you supposed to do?
Well, you turn to something called equity financing. It's a completely different game. Instead of taking on debt, you sell a piece of the pie. You find investors and you offer them actual ownership, a stake in your company's future success. And in return, they give you the cash you need right now. This is the engine that powers pretty much every startup you've ever heard of.
So this brings us to a really crucial crossroads, a fundamental choice every single founder has to make. Do I borrow money and keep 100% of my company, or do I sell off pieces of it to grow? Believe me, this one decision between debt and equity is going to shape the entire future of the business.
All right, let's really break this trade-off down. With debt, you keep everything. All the ownership, all the control, it's your ship. But you're on the hook for those fixed payments no matter what. If business slows down, bankruptcy becomes a very real threat. Now with equity, you give up some of that ownership and some control. But your new partners, the investors, they're in the boat with you. They share the risk. They don't get paid unless the company does well. They only win if you win.
Okay, so once you choose that equity path, you're not done, not even close. You've really just stepped onto the first rung of what people in finance call the funding ladder. See, raising money isn't a one-time thing. It happens in stages, and each new stage brings in new players and, you guessed it, much higher stakes.
It almost always starts small, with your own savings, maybe a loan from your parents, or a check from Uncle Jim. After that, if you're lucky, you might find an angel investor. That's usually a wealthy person who just really believes in your idea. But to really scale, to get big, you'll need to face the pros, venture capitalists, or VCs. And if you get even bigger than that, you might attract the huge fish, massive institutional investors, like pension funds.
But listen, a word of warning. Dealing with VCs is not for the faint of heart. These people are professionals, and they write some seriously tough deals. For instance, they'll demand something called liquidation preference. That means if the company gets sold, they get all their money back first, before you or anyone else sees a single dime. And that's not all. They have other terms to make sure they get a cut of the profits, too. They want to crush their risk and maximize their reward because they know most of their investments will probably fail. Their whole business model depends on finding one or two massive hits to pay for all the losses. Now, for the most successful companies, the ones that survive all of that, after years of climbing this private funding ladder, the final, biggest rung comes into view: going public through an initial public offering, or IPO.
But why do it? Why go through all that hassle? Well, it's not just about raising more money for the company. For the founders, it's about the exit. See, they might own a company worth millions or billions on paper, but you can't exactly go buy a car with that paper. An IPO is their big chance to finally turn that ownership into actual cash and to diversify their wealth so their entire life isn't tied up in the fate of just one company.
Going public is a massive, massive trade-off. On the one hand, you get access to enormous amounts of capital, plus tons of publicity and brand recognition. But on the other hand, you're now living under a microscope. You've got regulators and the public watching your every move. You face this intense pressure to deliver bigger and bigger profits every single quarter, which can sometimes force you to sacrifice your long-term vision just to hit those short-term numbers.
And this is where it gets really fascinating. Because when you actually dig into the data around IPOs, you find a few things that just don't seem to add up. These are often called the great IPO puzzles.
So here's puzzle number one.
If a company is trying to raise the most money it possibly can, you'd think they'd want to set their share price as high as possible, right? So then, why do we so often see a new stock's price just explode, jumping dramatically on its very first day of trading?
In the United States, the average first-day return for an IPO is about 18%. Let that sink in. An 18% jump from the price the company just sold its shares for. This phenomenon is called underpricing, and it basically means the company is leaving a whole lot of money on the table.
So, why would they do that? Well, it's not a mistake. It is completely intentional. By setting the price just a little bit low, they pretty much guarantee that all the shares sell, which helps them avoid a disastrous failed IPO. Plus, it gives all those first public investors an instant win, which creates a positive buzz and a ton of excitement around the new stock.
Okay, now for the second, and maybe even more confusing puzzle. If these companies are such hot investments on day one, why does the data show that over the next 3 to 5 years, they actually tend to perform worse than the rest of the stock market?
Well, one of the leading theories comes down to one thing: timing. Think about it. Who knows the company's real future prospects better than anyone else? The founders. So they might be choosing to sell their company to the public at the exact moment they feel the really explosive growth phase is over. In other words, they might be cashing out at the peak.
And here is the final puzzle for you. An IPO is by far the most expensive way there is to raise capital. I mean, to raise $30 million, a company might pay 10% in fees. To get that same money by selling bonds, maybe 3%. So if the goal is just to get cash in the door, why would you ever choose the most costly method? It kind of suggests, again, that an IPO is about a lot more than just funding the business.
So after that long, incredibly difficult climb from a simple coffee shop idea all the way to a public corporation, we're left with this one big question. Is an IPO the final victory lap for a founder? Is it the peak of the mountain? Or is it actually the beginning of an entirely new and maybe even more challenging journey under the constant, crushing pressure of the public market?